Let me now bring on board Gautam Shah to understand the technical setup, which sectors are on a verge of breakout and breakdown, and what should be a portfolio strategy at this juncture. Gautam, good morning. Thank you for joining us. Things are looking shaky. Could it get much worse before it gets better?
Good morning, Nikunj. I'm actually very happy that the markets are a little shaky at this point because when we ended September, there was this feeling that Indian markets are invincible and the domestic liquidity will keep taking prices higher forever. And I think there has been a sort of a reality check in the last 3 weeks. This was much needed. Things were going out of hand. I think at the starting of October, you had a scenario wherein market breadth was not in sync with the market action, and the market was gradually and internally getting weaker and weaker. So that has really showed up in the last 2.5 weeks. But what would have surprised a lot of people is that in this period, world markets have been extremely strong and Indian markets have gone the other way. But I think this is a platform to the next leg of the bull trend. I do believe that the medium term, long term uptrend of the markets remains intact, and this is not any major trend reversal which people have started to talk about. This is another healthy correction like we've seen multiple times in the last 3 years. The market is already very light. In terms of levels, I think we have been working with 24,000 as a number where the risk reward once again becomes very lucrative to take long trades. And we are getting into a seasonally positive period of November and December, and obviously with Diwali being next week. So I do believe that the current fall is a little overdone. The markets are gradually getting oversold. And I don't see more than 2, 3, 4% downside from here, whereas the upside potential is equally large. So this is an opportunity. One should make the most of it and not really think very short term.
But the shakeout in mid and small cap stocks is quite severe. I mean, there's a long list of stocks which are down 20%. There's a fat list of stocks which are down 30%. So for a lot of these bull market heroes, the correction is quite stark. Isn't that scary? I mean, Nifty is good, but when you fall more than 25-30%, technically you're in a bear market.
Well, there are two ways to look at it. I think if you look at the headline indices, which is the Nifty 50, the NSE 500, the NSE Mid Cap Index, and the Small Cap Index, they have actually not seen too much downside. Maybe because quality, smart money seems to be chasing quality stocks, and therefore they have been quite insulated from this market decline of the last 3 weeks. But aside of that, as you rightly said, there has been a fall of about 25-30%. But the problem is people are looking at how much stocks have fallen from the highs. People are not assessing what is the kind of gains the same stock have witnessed over the last 12 months, which could be a 2x, which could be a 4x, it could be a 5x. And if after that move stocks correct 25-30%, it's actually normal. In fact, even up to 40% is actually quite normal. So I don't think that's too much of a problem. This is how the market consolidates. And I think we've really gone through a time correction, because if you look at the small cap index, where it was in early July is where it is in the last week of October. So we've gone through 4 months without any serious damage on the small cap index. But internally, small cap stocks and mid cap stocks have lost a lot of ground when you speak to people on the street. But the clear message is stick to large caps. And even if you're doing mid caps and small caps, stick to top quality. They will survive. Narrative based stocks, story based stocks will not survive.
Interesting. So Gautam, let's dissect the market and let's first talk about the large caps. I know SMIDs, of course, are bleeding. Within the large caps, what is it that you're witnessing in terms of some of the key stocks which may be now, threatening their 200 DMAs or already sub that, and you think there is going to be a further sell-off in those?
Well, I think not many stocks are breaking the 200 DMAs as yet. I think more of a break below 50 DMA and 100 DMA is what that's happened. If you look at the three major pockets of the Nifty, the banks, the IT index, and Reliance. So Reliance is a complete underperformer, and I think it's going to remain this way for many weeks and many months to come. So that's not something which I'm hoping upon. But I think IT looks excellent on the charts, and it's likely to rebound and likely to deliver 15-17% upside from this Diwali to possibly next Diwali. So we remain quite bullish. And banks don't have room on the downside, because when I look at the top three names, HDFC Bank, ICICI, and SBI, I'm optimistic. I don't see these three stocks go down much. They might take time to go up, but I think the way HDFC Bank and SBI have behaved in the recent past, I'm quite optimistic that the bank Nifty is going to stay in that band of 50,000 to 50,400. So if these two pockets of the market remain relatively strong, we are not going to get into collapse mode. A 10-12% correction on the index is very normal, and we've seen it multiple times in the 2003-2007 bull market. So it's not a surprise. It's just that people these days cannot handle any correction which is larger than 5%, which is okay given the way markets have been for the last 3 years.
That we've been spoiled now given the recency bias that we have, that there's only one way for the markets and that's up, so can't really complain around that. Gautam, I remember you said of course SBI is likely to do a special thing this year, so that's one stock that you had, and the other thing that you said was this Diwali to next Diwali, I think IT you said is the best place with 15 to 17% return expectation. But what about autos? Would you buy that in any of the dips, or that's looking very weak at the moment?
No, auto as a sector is a complete avoid. I think that's been our stance for the last couple of months. We've been extremely bullish on it for the last couple of years because we spotted this mega breakout on the auto index, and thereafter the follow through was amazing. And some of these top stocks delivered supernormal returns. But I think the next 3 years of positive action in terms of news flow, fundamental news flow, is in the price today. So auto is a complete avoid at this point of time. I don't see any opportunity there. It will remain in consolidation and correction mode for many weeks to come. But along with IT, the other sector that we like, and we have been advocating this for a while now, is the metals index. I think it's at a point from where it could actually deliver one of the best sectoral returns over the next 1 year. So metals, IT and pharma would really be on top of our list, along with select stocks in the financial services space.
Capital goods underperformer, FMCG. Let's look at that sheet again. I'm just going to recap it for our viewers here. What is green and what is red in terms of the technical strength? This is a framework what Gautam follows. Underperformer, FMCG, weak setup. Tech outperformer, something which we've already discussed. Gautam, the bull market heroes of this market are the capital goods stocks. And when you say they will underperform what? The Nifty, they will underperform the market. When you say underperformer, what do you mean by that?
See, again, look at the context, look at the backdrop. For the last couple of years, many of these capital goods stocks have gone up anywhere between 1x to 4x. And therefore, they needed that consolidation, which has been happening for the last 4 months. When I say that they are underperformers, I mean that in terms of Nifty, in comparison to the Nifty, they are likely to underperform because for the last 2 years, they have been standout outperformers. I think they need a little bit of breather, which is what is happening right now. I mean, if you look at a chart of L&T, that's a great example. The stock has done absolutely nothing for the last 3.5 months. It's just quiet. And you get these phases from time to time. Not to say that the capital goods, manufacturing, story that India is holding upon, that's not going anywhere. So if somebody has a 3 to 5 year view, these are sectors and stocks to definitely commit into. But unfortunately, in today's world, everybody is talking 3 to 6 months, and in that time frame, I don't see them as outperformers.
Next 1 year, that means if somebody, let's say, either has to buy IT or sit on cash.
Well, I would go with gold and silver. Why go for IT or why go for cash? I think, this domestic money revolution will ensure that there is always some pocket in the market which does well. And that's probably the reason I say that IT, pharma, and metals are three spaces where one should commit into. And not to forget gold and silver. I think that's a brilliant asset class which helps you with the hedge, which helps you with inflation, and with helps you go negative beta. So I think gold can easily do a 33.50, which has been our working target. Silver can easily do a 41. So we are talking about 20-25% upside. And let me also tell you that on the Nifty, it's just the near term which is a little challenging. But as the markets start to reverse, which I think will happen in a few weeks, I think my bigger working target for the next 1 year for the Nifty is about 26,800. So anything around 24,000 plus minus 1-2%, I think is a good opportunity to invest.
Talking about gold and silver still rallying around 20-25% from the current level, and the fact that it's already 20% this year as far as gold is concerned. Interesting. You talked about L&T being sideways for the last 3.5 months, but the other big boy which has been a pain point for the market is Reliance. Where do you see that one headed?
Well, I don't see it heading anywhere. I think it's been a very difficult chart, to be honest. In the good times, the stock did not participate. And in the difficult times, the stock is leading the market down. Even now, the setup is quite weak. I think the stock is headed towards levels of 2,500 and below. And even if the markets start to rebound, I don't see Reliance coming back anytime soon. So broadly, it's going to stay in this band of about 2,500 to 3,000. On the other hand, if you look at SDFC Bank, because for large investors, it's really about whether SDFC Bank or Reliance. I do believe the way SDFC Bank has behaved in the last 2 months and the way 1,600 as a level has worked out brilliantly, I do believe that over the next 1 year, at some point of time, you are going to see SDFC Bank get at levels beyond 2,000. And I think that will be an event which the market will celebrate.
That's quite interesting. Not as meaningful, but just wanted to understand, Gautam, because it has such a pure connect to the economy and the demand side things. Wanted to understand, what is it that you make of FMCG, and when is it that there we would see a meaningful recovery? What are the charts indicating so far?
See, there's a lot of debate as to how consumption is picking up in the economy and how the economy is doing and how it is likely to do over the next 3 to 6 months. So there are different views on account of that. But if you have to really play consumption and FMCG as a theme, again, I want to go with the big boys. I don't want to go lower down. I'm still very, very comfortable with ITC and HUL. I think at 470, 480, there is just not much to lose in ITC. And again, I'm quite confident that over the next 1 year, you will see an ITC move gradually towards a level of 600. And HUL also presents an opportunity after the correction of the last 1 month. But if you look at the other names, the Maricos and the Daburs and the Godrej consumers of the world, I don't get that confidence to make serious commitment. So stick to the top 2 names, and I think you should be okay.
Okay. So gold, silver, and IT. That's it.
No, not to forget metals, Nikunj. I think I was quite vocal about it. And I do believe the way the metal stocks are shaping up at this point of time, I think you are going to see a large rally once the market stabilizes and starts to do well. Even pharma, for that matter. I mean, look at Sun Pharma, look at Cipla, look at Dr. Reddy's. They've all been super steady in this correction of the last 3 weeks. And I don't think the uptrend is going anywhere soon. Even mid caps and small caps are an opportunity. You just have to be selective. Don't be in high beta. Be in low beta in mid caps and small caps, and with the industry leaders and the industry challengers. I think that will deliver alpha for your portfolios.
In this market, is it a good idea to even go short? I mean, if markets, you don't expect upside. Upside is limited. The downside is a function of sentiment and mood. Mood has changed, momentum has broken. And people laugh when I say go short in a market or buy puts. But what's wrong in it?
Well, nothing wrong with it. It's just that market has made us forget about how shorts are and what shorts are and how one should short the market. Because in the last 6 to 8 months or 12 months, every time there has been a correction and people have looked for shorts, they have been taken to the cleaners because the markets turn around and they go on to make new highs very quickly. This time has been different. I think right from the starting of October, we've been very vocal that the market is weak and it will not turn around quickly. There are some selective shorting opportunities, no doubt about it, but I'm still looking at the bigger trend, which is up, and I'm more comfortable staying quiet and then looking for opportunities closer to supports, because as the market stabilizes and turns around, I think we'll be back up quickly. Not to forget, we are in a global equity environment where most markets in the world are doing well. So India cannot stay down for too long. Let this FI selling get absorbed. Let's get into the Diwali week next week, and I'm pretty sure things will stabilize soon.
Okay. On that positive note, Gautam, we'll let you